Welcome to today's Explainer. We are diving straight into a high-stakes, tactical war room report that details exactly how physical choke points and energy wars are driving a massive, completely irreversible financial migration. Look, we're talking about a structural shock that really hit critical mass in 2026, forcing global capital to basically panic and regroup. It's this fascinating, high-stakes intersection of geopolitics, energy grids, and decentralized finance. And honestly, the data signaling this shift is totally unprecedented. To make sense of all this incredibly dense data, we're going to break things down into four key areas: the physical front, the energy and compute front, the financial escape hatch, and finally, a long-term forecast mapping this out to 2028. All right, let's jump right into Section 1, the physical front, where we'll look at the geopolitical and logistics blockades. The sheer scale of the disruption happening on the ground right now is literally staggering. The geopolitical lock around our critical maritime arteries is tightening, and it's tightening fast. Down at the Strait of Hormuz, we're facing a near 30% drop in transit capacity because of military convoys and severe mining threats. But Bab el-Mandeb, that is seeing an astonishing 58.1% drop in capacity. It is essentially acting as a full-blown blockade for Western operators. And naturally, because of these massive bottlenecks, Brent crude oil has been stubbornly pinned above $78 a barrel. So what does this actually mean for the rest of the world? Well, it creates this massive ripple effect, locking us into a true logistics blockade. With the Suez Canal practically off-limits to standard commercial vessels, ships are forced to take the long way around the Cape of Good Hope. That pushes transit times up by 10 to 14 days and skyrockets insurance premiums by 300%. Add in a persistent systemic drought that's severely capping capacity over at the Panama Canal, and you've got the perfect storm completely choking global supply chains. And hey, it's not just the oceans taking a hit. Closed air corridors over key Eurasian regions have spiked the transport cost of critical AI hardware, we're talking GPUs and ASICs, by 48%, just from longer flight paths and a total lack of landing slots. But honestly, the most sci-fi element of this whole physical front is what's happening underwater. With undersea optical cables getting cut in the Bab el-Mandeb Strait, we're seeing serious latency deficits. In response, high-frequency trading algorithms are literally abandoning fiber optics and migrating to satellite networks like Starlink and Cooper just to eliminate the physical risk of severed cables. Crazy, right? That incredible structural tension brings us perfectly to Section 2. The energy and compute front, or what's basically the thermodynamic clash of the century. When you look at the baseline energy required to power the AI age, the strategic contrast is pretty wild. The report highlights China with up to 39 nuclear reactors in active construction specifically to power its tech infrastructure. The US, currently building 0. Computing power and artificial intelligence demand massive, uninterrupted baseload energy, and we're looking at two very, very different realities for securing it. This infrastructure gap perfectly illustrates the immutable law of industrial physics driving this entire economic cycle. As the report bluntly states, there is no such thing as a low-energy, rich country. The big takeaway here is absolutely crucial. Liquidity and wealth flow directly and inevitably to where there is abundant, stable energy to support massive computational output. But you know the market. It always finds a backdoor around physical limitations. Enter the electron gap. The report defines this as the widening energy compute deficit. To counter centralized monopolies and localized grid limits, decentralized physical infrastructure networks, like IO.net, are stepping in to close the gap. They're doing this by allowing decentralized AI models to crowdsource and rent latent GPU power from absolutely anywhere on Earth, completely bypassing local geographic bottlenecks. It is decentralized problem-solving at its finest. With physical supply chains choking out and energy wars heating up, we move to Section 3, the financial escape hatch, decentralized finance and AI agents. What the data proves is a massive panic-driven migration of global liquidity. Capital is fleeing the regulatory uncertainty, the heavy-handed KYC requirements, and the very real asset seizure risks tied to traditional centralized exchanges. Instead, wealth is sprinting toward decentralized exchanges, or DEXs, treating them as non-custodial, autonomous safe havens that operate entirely on-chain. This capital flight is so severe right now that the CEX to DDX volume ratio just plummeted to a record low of 3.5%. Inside the War Room report, this triggers a literal high alert DEFCON 2 status. It's a glaring mathematical indicator that traditional financial jurisdictions are losing their grip on global liquidity. But here is the wildest part of this migration. Who is actually doing the trading? If you look at Solana, which has become a primary execution layer for these fast financial transactions, up to 48% of the volume is now generated by autonomous AI agents. Think about that. Almost half the network is non-human actors optimizing arbitrage flows and scraping liquidity entirely on their own, 24/7. No humans involved. Obviously, though, an ultra-fast, highly leveraged environment like that carries massive risks. The report gives us a great real-time signal regarding the HYPE token. With the price at $66 and a record-breaking $3 billion in open interest, combined with positive funding rates, the market is historically over-leveraged. The report flags this as a giant red sell zone. The asymmetric risk of a flash crash causing cascading algorithmic liquidations is huge. It's a clear mathematical signal to take strategic profits and wait for a healthier baseline. Finally, we reached Section 4, the long-term forecast to 2028, looking at scenarios for the ultimate wealth transfer. And honestly, relying on infographics for longer periods is absolutely crucial here to map out exactly where this structural shock is taking the global economy, making a complex decade-long shift much easier to grasp. Following this timeline, the report operates on a universal formula. Information output must equal energy input. Because of this dynamic, we're entering a massive transition cycle spanning from 2026 out to 2035. As traditional state debt devalues and the physical world stays locked in friction, we are tracking a projected $30 to $80 trillion wealth transfer straight into hard, cryptographically secured assets. By 2028, the expectation is that the on-chain economy will fully dominate global financial settlement. So, what does that actually look like for the markets? By April 2028, the report lays out 3 potential scenarios. In a conservative scenario, we're looking at a $150,000 Bitcoin baseline and Solana at $350, with decentralized platforms cementing themselves globally. The base scenario, Bitcoin hits $280,000, driven by total AI agent domination in DeFi. And the aggressive scenario, this is where things get wild. We see a structural collapse of traditional clearing systems, blasting Bitcoin over $500,000 and Solana over $1,200 as global standards shift entirely to zero-knowledge proofs. So tying it all together, this data points to an epic convergence of quantum computing, AI, and decentralized finance. As we face the threat of totally locked-in ecosystems controlled by just a few silicon giants, the ultimate question you have to ask yourself after this explainer is this: will decentralized infrastructure successfully rise up to break the monopoly by 2028, or will total centralization ultimately win the global energy war? The battle lines are already drawn. Thanks for joining me on this one, and keep your eyes on the data.